What's up everyone, and welcome back to the Elephant Advisory YouTube channel. And in today's topic, we are going to talk finance and specifically lender's mortgage insurance with our 8 tips to better understanding. Number 1, lender's mortgage insurance or LMI is an insurance contract that's required when you generally have less than 20% deposit to put towards a property. In these circumstances, having less than 20% deems you in the high risk category where an insurance contract is required. Number 2, lender's mortgage insurance, just like other insurance contracts like car and home insurance, can vary between provider. Different banks are having a different risk profile for your specific loan, may charge different lender's mortgage insurance. And this can be upwards of $3,000, $5,000, all the way up to $50,000 we have seen for different client scenarios. So it's really important when you're thinking about lender's mortgage insurance, or if you're in the bucket of having to pay for lender's mortgage insurance, that you might be well worth speaking to someone who has access to multiple lenders. Number 3, very different are the insurance contracts where your insurance protects you in case you're in an accident or your home is damaged. Unfortunately, lender's mortgage insurance is completely backwards. Albeit you pay for lender's mortgage insurance, it actually protects the bank in the event that you default on your mortgage. Don't ever get confused in thinking that lender's mortgage insurance is some sort of contract to protect you, the owner and the borrower of that property. Number 4, so how is lender's mortgage insurance paid? Well, there are 2 general options. 1, it can be added onto your mortgage and then paid off just like your normal principal due in a loan, and this item accrues interest. Or 2, it can be paid out of your own cash. Now, very important to understand that in some instances, banks, instead of charging lender's mortgage insurance, might charge what's called a risk fee equivalent to that pricing. So it's really about knowing what's available out there for your scenario. Number 5, so what does lender's mortgage insurance actually protect? Well, the reality is lender's mortgage insurance protects any amounts owed to the bank above the 80% threshold. So if you're getting into a dire situation where you have to sell your property and the price of that property sold does not meet the actual loan available, lender's mortgage insurance kicks in and assists the bank in recouping or buffering the loss of that loan. Now, it doesn't affect the whole loan balance. As an example, if you have a house for $500,000 and for some reason the loan on that house is $600,000, that $100,000 loss that may occur can be partially paid by lender's mortgage insurance, but you also might be on the hook for paying off that mortgage. In the worst case scenario, you sell and the sale price cannot cover your loan. So it's really important to understand that lender's mortgage insurance is not a get out of jail free card. Number 6, it's really important to harp on who this insurance contract protects. In this example, the bank is the one that is covered in lender's mortgage insurance. We always suggest it's really important for the borrower to have their own health insurance, home insurance, even TPD and life insurances, so total disability and life insurance, to ensure that in any unfortunate circumstance in life, there are other sources of contract that you, the borrower, can call upon to assist paying your mortgage repayments. Number 7, and one of my biggest pet peeves with lender's mortgage insurance is it is not transferable between lenders. Once you pay your lender's insurance once with a certain bank, let's say CBA, and one day if you want to refinance to another bank and your property value hasn't gone up, or you haven't paid your mortgage down enough to avoid mortgage insurance, you cannot transfer that contract above. So you would have to pay it again. And this is really important to understand the risk of getting stuck with a lender for a really, really long time. It's really key to know that albeit you're paying mortgage insurance for your 30-year loan, it doesn't move. Number 8, and the final one, and a bit of a bias. As a mortgage broker, we have access to a lot of different lenders, and there are some that can avoid mortgage insurance in certain examples. Maybe your profession, maybe the type of property, maybe your first home buyer. any kind of swing that you can have in terms of credit policy with a bank that can help you avoid mortgage insurance is super valuable because it saves you a ton of money. Well, we hope that these 8 tips help you better understand mortgage insurance. It is such a complicated topic when you're going and buying a house, along with a myriad of other things that fly your way. It's important you speak to someone that cares enough to go through LMI and really get you understanding who it protects, what it entails, how much it costs, are there better options, are there ways to avoid it? So reach out to your mortgage broker because we think they're the best place. Well, thanks again for tuning in. If you like this video or want more, please hit the like or subscribe button. We would really appreciate it. Thanks again. Bye.